Your equity market is bouncing into this one. From New York City this morning, good morning, good morning. We are higher on the S&P by 1.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York, we begin with the big issue, counting down to Chair Powell.
The issue here is how strong a signal do they want to send?
During the press conference, I'm sure Jerome Powell is going to be peppered with questions.
Everyone's trying to figure out, what is the Fed going to do?
Maybe in the statement they give a little bit more color about tapering.
At this point, they still want to keep their optionality.
The press conference.
Those these days, I think, are even more interesting than when we first hear at 2 o'clock Eastern.
You're going to hear hawkish messages anyway for the next several months, if not all year.
That's not a foregone conclusion.
Powell is going to come out and say, look, we're data dependent.
Not just that we're data dependent, but we don't have a pre-prescribed path.
He's a very disciplined communicator.
They know they're behind the curve.
The Fed doesn't have to move as aggressively as the consensus is starting to believe.
Powell's going to sound a lot more dovish than some of the extremely hawkish economists.
As always, a fantastic panel right now. Joining us, Morgan Stanley's Matt Hornbach, PGIM's Robert Tipp, and Kathy Jones of Charles Schwab. Kathy, let's start with the recent volatility in this market. Will the Fed respond to this in any way, shape or form?
No, I don't think so. Volatility is to be expected when the Fed moves from really super easy policy towards less easy and talk about tightening. But so far, it doesn't seem to have spilled over into the real economy, and their focus now is on inflation. So I don't think they'll respond to it at all at this press conference or at this meeting. We'll find out a little bit later this afternoon. Matt Hornbach, Bank of America, say investors should not assume the Fed will step in to placate volatile markets. Tightening is wholly appropriate. But given where the bar is, I thought this one from Renaissance Macro might interest you. From Neil Dutter. Given the current pricing in markets, an indication that the Fed will not be starting with a 50 basis point rate hike might be enough to provide a floor under risk sentiment. Matt Hornbach, how do you interpret what all of this will mean for the Fed a little bit later?
I mean, John, I think we should probably start talking about the Fed hiking at every meeting before we start talking about the Fed hiking 50 bips to kick things off. I mean, that would be quite a shocker if they were going to start with 50. I think the real question for this meeting is, what kind of indications do we get about what comes after the March FOMC meeting? Are we talking about a Fed that's going to be raising rates 7 times this year, right? Are we going to be talking about a Fed that hikes rates at every meeting starting in March? Or are we going to be talking about the Fed of 2016, 2017, 2018, where they were hiking once a quarter only? That's, to me, the real question here, John.
Robert Tipp, do you think the Federal Reserve knows the answer to that question just yet?
I think the market is going to be looking at where the Federal Reserve is going to be in a year. And that may sound crazy, but if you rewind the clock about 10 months to March of last year, that's when the dots dislodged from zero. And the Fed went from full bore, all hands on accommodation to, if we need to hike later, we will hike. And when that happened, long-term interest rates peaked, 30-year. And then subsequently, as 30-year rates peaked, and then as we went through the year, and it became clear they would move aggressively, we've seen break-evens level off. So I think right now the markets have moved on to where are we going to be in a year. And the Fed's track record of managing these hikes, balance sheet roll-off, is very poor. And we're, seeing right now in recent history over the last 20 years, the last 2 plateaus for Fed rate hikes, for Fed rates after the hikes have been very long. June 06 to October 07 was the longest they managed to stay at the peak. And the reason I'm saying that is because they tend to make mistakes. They made it last time with their roll-off. So I think the markets right now have gone into an in-between point. They used to be very supportive of the Fed's stance. Now they're halfway in between. Yeah, they'll get a soft landing. And no, they're going to break this.
Mike McKee leading our coverage a little bit later. Mike, is there anything left to say about a Fed decision we've been discussing for about a month now?
Probably not, John, although we could urge everybody to celebrate Fed Day carefully. The Fed doesn't like to surprise the markets, and that's why the script seems to already have been written for people on trading desks. There's not going to be any change in the target today. They are going to probably have to say in the statement that they are close to or at maximum employment, which would make a rate increase appropriate soon. They will talk about the balance sheet only in the sense of the statement will say they're still tapering. Maybe Jay Powell will tell us something about whether or not they're going to stop it early, but that's unlikely. So then we get to the questions in the Powell news conference, and this is what the folks on the trading desks want to know. The rate rise, how far, how fast, and when? Is it going to be March? The balance sheet, when, how much? Best guess is he'll put it off till later this year. And guidance. What markers will the Fed use to know whether it is still going, since we don't have to worry about maximum employment or unemployment rising in the Fed's statement? Now, here's the real question, and this gets to what Robert Tipp was just talking about. If you look at this, the white line is the Fed funds rate, and every time they have significantly raised rates, it has put us into recession, or let me say, a recession has followed. But here's the other interesting thing. The blue line, that's PCE inflation. Notice, John, that every time the Fed has had to cool inflation, it had to move the Fed funds rate above the inflation rate. And look at all the way over on the right-hand side where the inflation rate is and where the Fed funds rate is right now. That might tell you something about how many rate increases are going to be coming. We'll have to see how the market reacts to the Fed raising rates.
And Mike McKee, that's the tension point. That's why Bill Dudley, the former New York Fed president, said these Fed forecasts are in, quote, fantasy land. Look to 2024 in the current dot plot. Rates there just north of 2% for 2024. Kathy Jones, do you think that's fantasy land?
No, I don't. I think that the Fed will be hiking rates and presumably engaging in quantitative tightening going into a slowing economy in the second half of the year. And also the assumption is that inflation will start to ebb a bit as supply and demand balance out and as the Fed tightening already has an impact on the economy. I mean, just today we're starting to see the mortgage applications come down, the refi activity will slow down. So I don't think it's fantasy land. I think that some of the expectation that it will all be done with rate hikes may be misplaced. I think the Fed has a lot of optionality with the balance sheet, and how they manage that vis-a-vis the rate hikes will be an important component of how quickly we get back to, a lower demand economy that brings inflation down. We're looking at, the possibility of QT in the second half of this year being the equivalent of 1.5 rate hikes. So that may take some of the pressure off the Fed funds rate going forward.
Robert Tipp, can I get your view on that? We've heard from Bill Dudley. Yeah. He thinks that rates need to go north of 3%, maybe towards 4%. Jeffrey Lacker said a similar thing earlier this morning with us on Bloomberg Surveillance. Robert, that's even with a balance sheet reduction of maybe $1.5 trillion from the middle of this year to the back end of 23. Is that achievable?
Right. Those kinds of interest rates, I mean, there is a scenario where that could happen. But, looking at the track record, of some of those individuals, I think they overestimated how high the Fed funds rate needed to be before they were at the Fed. They went into hibernation as a hawk while they were there, and they've come out and they're back on the hawkish side. That would be my guess. On Michael McKee's graph, if you notice, every time the Fed funds rate rose above the PCE, it did so by a smaller margin. So I think as the economy has become increasingly indebted, that level of interest rates that the economy can support has fallen lower and lower, number one. Number two, those other incidents of inflation were endogenous. They were the result of strong demand. To some extent, in 08, you had an unusual oil price environment. But that's not uncommon. When you have a strong economy, demand is good. But right now, supply is definitely crimped. And what the Fed is lining up to do is get expectations there to hike 4 times next year and to begin balance sheet roll off in the middle of it. Even last time when they did their rate hike process, they hiked at the end of 2015. They started in 2016. When they moved into balance sheet roll-off, they were at about 1%. They skipped a meeting, they waited 6 months, and then they started raising rates as they were rolling off the balance sheet. And the next thing you knew, the primary dealer system was running out of money. So they have not been very good at estimating this, and they're lining up for a much faster process than what they had before. Is the economy really strong? It is right now, but where is it going to be when reopening winds down and the fiscal stimulus begins to ebb? So I think you're going to have a quieter end to the year than beginning of the year in terms of Fed bark.
Matt Hornbach, that's what you're worried about as well. We start with an inflation problem. We start to talk about the solution, the policy response to it. And then you start to focus on the growth slowdown. Mike Wilson wrote a lot about that over the weekend, Matt. Your thoughts on that at the moment? Growth risk in the back half of this year?
Well, John, the first thing I'll say is fantasy land is very hard to predict. And I think, thinking about the funds rate, thinking about what growth does in the back half of this year is very hard to predict. And I think even if we do get a growth slowdown, which, by the way, is not the forecast of our U.S. economics team, we actually have growth doing pretty well in the back half of this year. So, the equity market might be discounting some slower growth in the first quarter, but we think there should be a good growth rebound into the second half of the year. And as far as, the Fed raising rates, getting above 3% in this cycle, it's certainly a possibility. Thinking about the debt structure of the economy that Robert talked about, the private sector debt that's outstanding is actually lower as a percentage of GDP today than it was in the great financial crisis. Federal government debt is a lot higher, but that's a good thing. That actually, in my mind, makes it more likely that the Fed can raise interest rates and that interest rates can be a little bit higher in this cycle than they were in the last cycle. Can we get to 4%? I mean, that's a tough one to call. But I'd say, do we have a good shot of at least getting back to a 2.5% funds rate? Absolutely, John.
Matt Hornbach, Kathy Jones, Robert Tipp sticking with us. Your equity market up 1.3% on the S&P, on the Nasdaq up a little more than 2 percentage points with the price action. Here's Abby.
John, not surprisingly, with those big gains, the best day right now, heading to the best day of 2022. Lots of big movers. The biggest, of course, Apple. That's the biggest weighting to these indexes. Right now, up about 2%. As the company tomorrow will be reporting its key earnings report. On the news also that the iPhone maker was the top smartphone maker in China for the fourth quarter for the first time since 2015. But of course, it will be all about earnings tomorrow. JP Morgan up 1.1%, in line with yields backing up. And then Tesla, the big report tonight, up 4% ahead of that. They will have to put up a blowout quarter, some are saying. Right now, the street's looking for $2.36 on $16.64 billion. It will come down to, a big piece of it will be that deliveries number. The street estimating that to come in at 1.38 million for the year. Let's see whether or not that high valuation momentum stock can keep it going if there is that big report, John.
Abby, thank you. Coming up on this program, President Biden calling on corporate America to promote his economic agenda.
The bottom line is our economy shouldn't be about people working for capitalism. It should be about capitalism working for people, for everyone.
That's up next. This is Bloomberg.
The legislative process. It doesn't move for the most part at a high rate of speed, and you have to keep working. I'm optimistic that we're going to pass a significant, very positive for the American people, Build Back Better bill.
Today, President Biden inviting CEOs to the White House to promote that Build Back Better bill. The president highlighting General Motors' $7 billion investment at EV manufacturing sites, writing the following. This announcement is just the latest in over $100 billion of investment this past year in American auto manufacturing to build electric vehicles and batteries. On this renewed effort, here's Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John. Well, when it comes to GM, part of that renewed effort of them trying to get some new plants and battery manufacturings and push ahead with EVs, the funding for that, $1.8 billion, comes from incentives from the state. They want to make sure that they can keep these jobs within Michigan. So it's no surprise to me that two of the standout CEOs that are going to be meeting with the president today are GM and Ford, because part of what's in this Build Back Better agenda is going to be focused on climate and electric vehicles. We heard from Ron Wyden yesterday, a key Senate Democrat, and he said when you look at the Build Back Better and you're trying to get some of these chunks passed, he thinks that what could potentially go through are lowering of prescription drugs and, of course, climate provisions. And in those climate provisions, Jonathan, is potentially going to be more incentives for the American consumer to buy electric vehicles, especially if they're made with union workers in a major Detroit automaker. We should note, though, Jonathan, a White House official has said that while these executives don't agree with everything part of the bill, particularly if there's going to be higher taxes on corporations, they do believe that the costs are worth it.
AMH, just quickly, there's a $900 billion company called Tesla. Why do I never see Elon Musk on these lists?
I tried to ask the president over the summer when he was driving around the White House in his EV Hummer, but that was made from a union worker shop, Jonathan, and that's what it comes down to.
So it comes down to, if you're an American manufacturer and you don't use union workers, this White House doesn't want to work with you.
I don't know if I would want to go on the record saying they don't want to work with you, but it doesn't seem like the incentives or the initiatives have been there. And I believe Elon Musk did take to Twitter and say he was not invited at the White House. Potentially the White House maybe wants to consider inviting the likes of Elon Musk or the American president of Toyota. We should note Senator Joe Manchin has gone to the Toyota plant talking about the fact that he believes in these incentives, but not if they're going to categorically marginalize some other corporations.
If you believe in capitalism, you believe in private enterprise.
A free market.
They can employ who they like. Anne-Marie, thank you very much. Down in D.C. We appreciate it. JP Morgan's Michael Ferrari weighing in on the inflation argument. I want to get back to this for this Fed. I've asked this repeatedly through the week. Has the Fed actually given up on the underlying argument of the T word? Yes, they've given up the T word, but have they given up on the story? This is what Mike Ferrari says. If the transitory story hasn't already been completely demolished, further evidence of building wage pressures, wage inflation, should really put the final nail in the coffin. Kathy Jones, can I come to you on that quickly? Do you think this chairman has given up on the underlying argument around the inflation picture?
I would be surprised if he did. I'm not a mind reader, but Jay Powell was on the dovish side. And I think although he apparently converted to a hawk based on the rise in the ECI, I do think that the view of many of the Fed members is that the underlying inflation rate in the U.S., once we get past the supply-demand imbalances, is going to come back down. And you can even see that in the market. I mean, if you look at the five-year forward, we're pricing about 210 right now. So the market is certainly believing that the underlying rate of inflation is going to come back down. And I think that that's probably where Powell is. But of course, they have to respond to the immediate rise in inflation right now. It can't afford to sit back and, test the theory that it can take a bit longer and try to figure out what the time frame is. But I do think he's more dovish than perhaps the committee is at this stage of the game.
Matt Hornbach, I think this is what you were getting at about 20 minutes ago. It's the glide path post-March. What does it look like, Matt?
Well, and that's the $64,000 question, John. Is this a Fed that just wants to reset policy to a level that makes them feel a bit more comfortable about the current inflation outlook? So maybe they hike in March and May and in June, and then start the balance sheet normalization process and then wait and see? Or is this the Fed that is more like the Feds that we've seen over the past two cycles, where they've set a process in motion and they let it run until they decide to stop it for good? That's what I think we're really trying to figure out this year. And perhaps because the Fed doesn't like to surprise markets, although judging by how they behaved over the past couple of months, I'm not so sure that applies anymore. But if they really don't want to surprise markets with the pace of rate hikes, we should start to get some clues today, John, about what should come after March, not just at the March meeting.
Robert Tipp, final word here in 60 seconds, sir.
Yeah, I think the biggest element for the market here is whether he keeps this reality based. I think the politics landed on the transitory and put the blame for inflation at the feet of the Fed. I think the main thing will be if they signal that they are going to do the right thing. This is not going to be a set it and forget it. This is going to be, if the economy is burning hot 9 months from now, yes, we will continue to take all of these steps. But if we see moderation and if we see a soft landing, we're going to move to the sidelines. I think that's what the market wants to hear. Because in the past, they've been too much on the set it and forget it. They overshoot and they end up back in the same problems they had before the expansion of too low inflation and so on. So I think if he can keep it real, keep it focused on now, doing the right policy at every meeting, and not overcommitting on future guidance, I think that will be the best course.
Robert Tipp, Matt Hornbach, Kathy Jones sticking with us. Coming up on the programme, the morning calls, and later, why some at Citi and Goldman think this might be a buying opportunity. More on that still ahead. Futures positive, 2% on the Nasdaq, up more than 1% on the S&P 500. From New York, we are 8 minutes away from the opening bell on this Fed decision day. This is Bloomberg. Remember this, the last time the Fed met, December 15th, the Nasdaq 100 closed higher that day by 2.35%. When we got the minutes in the first week of January from the same meeting with basically the same story, the Nasdaq closed lower by more than 3%, down about 3.12%. Think about that as we see futures rise, going into this one, up by more than 2.2% on the Nasdaq 100. The last time the Fed met, December 15th, the 2-year was just north of 60 basis points. There has been a monster change since then. We are through 1 percentage point on the US 2-year. Is that enough baked in? Are we really discounting what this Fed is going to have to do over the next couple of years? And how on earth do you discount how much Fed work this Fed has got to do over the next couple of years if you factor in $1.5 trillion of balance sheet reduction into the end of 23 in the minds of Deutsche Bank and others too? Your 10-year yield right now, 177.30s, a little north of 2.1% at 2.1155. That's the price action here, the morning calls. JP Morgan downgrading Verizon to neutral. The analysts forecasting limited potential for capital returns due to the highly competitive wireless environment. Morgan Stanley upgrading DraftKings to overweight, seeing an attractive buying opportunity following recent declines. Credit Suisse downgrading Clorox to underperform, expecting slower sales growth and weakening consumption and rising inflation. Up next, banks from Citi to Goldman indicating there might be a dip to buy. Let's look at where we are on the year to date, not even a month into this, versus where we are on the session. Coming into Wednesday, the Nasdaq 100 down by more than 13%. The S&P 500 down a little more than 8.5, close to 9 percentage points lower. Your equity market this morning with a bounce. Futures up 1.5% on the S&P. On the Nasdaq, up by more than 2 percentage points. That's the opening bell. Switch at the board and get to the bond market. Let's look at 10s and where we were in the middle of December. The last time the Fed met, December 15th, at the close that day, 145.65 on 10s. We've had a big move since then. From December 15th to the close at 145.65 to 177.44 right now. And year to date, over the last 3 weeks and a few days, up 26 basis points on the 10-year alone. This bond market has done a lot of work to start the year. In the FX market, the euro showing just a little bit of weakness again against a stronger dollar. Euro dollar down to 112.94, down almost 1/10% there. Look out, crude up another 0.9%. The rally's back on to 86.40, up about 80 cents on the day, up 0.9%. Around the open then is the rebound you were looking for. 45 seconds in, we're up 1.5% on the S&P. Information technology top of the pile. Big move there, higher by 3%. At the bottom, underperforming. Consumer staples down 1/3%. Healthcare basically unchanged. Utilities basically unchanged. A ton of volatility, and BlackRock's Kate Moore says there's more to come.
Is it time to dive into the market wholesale? I don't think quite yet, John. I mean, I'm looking for the Fed to actually begin liftoff to sort of usher in an era of perhaps modestly less volatility than we've experienced in January. Like, our base case expectation is that Powell's going to sound a lot more dovish than some of the extremely hawkish economists who've been upping their forecasts over recent weeks and since the start of the year. But that may not be enough to completely calm the markets.
Back with us, Matt Hornbach, Kathy Jones, Robert Tipp. Robert, I want to come to you as something Lisa and I have talked about through this week. There's a difference between market functioning and market pricing. The Fed would be much more concerned, I think, at the moment at least, about the former and not the latter. Is there anything to be worried about when it comes to market functioning? Is anything about this disorderly?
I think so far things are reasonably good, and I'm sure Matt will have something to say on this as well. But I think the two go hand in hand. And what's not to be forgotten is that over the last 12 months, it's been a very buoyant retail flow environment. You had better part of $1 trillion going into both equity and bond mutual funds. And you had all the world's central banks doing their part, injecting liquidity into the system. And you had new facilities to offer financing or to park your money overnight. So it has been an incredibly facilitated backdrop. And now we're looking at an environment where the central banks are really scaling back those purchases, and the markets are becoming more volatile. You're kind of seeing a setup. I mean, we've seen a tremendous volatility in January. So hopefully we're not going to see this kind of level of volatility throughout the year. That would basically be like 2018. So if you get that environment and you get the market volatility, you will begin to lose market function. You will see illiquidity come back into the system. Now, will you have where the kinks in the market are going to pop up this time? Last time it was repo. I'm not sure, but illiquidity at any rate and market volatility tend to go hand in hand these days. And I think that's what the Fed is going to have to guard against. That's what's going to be the canary in the coal mine for them as they go through this withdrawal and stimulus process.
Matt Hornbach, your take on this?
Yeah, I completely agree with Robert. I think when we look at the relative value opportunities that you see on the Treasury curve, typically when market function breaks down, you see a lot more relative value opportunities show up along the Treasury term structure. You're seeing a little bit more today than you did at the height of the liquidity provision over the past 18 to 24 months. But John, the relative value opportunity set is still less than it was during the entirety of the last hiking cycle. So I don't think the Fed can look at what's happening in the Treasury market today and think that something is broken or they're getting even close to the period of time where something might break. We're still trading in a very healthy environment. And John, let me just add that probably the biggest area of concern in the Treasury marketplace is with the TIPS product. And if there was truly concern about liquidity in the TIPS market, then I doubt the U.S. Treasury would be asking primary dealers whether they should issue even more TIPS to the marketplace. So I think we're quite a ways away from anything breaking down in the Treasury market, John.
Kathy Jones, your thoughts?
Yeah, I would agree. There's no indication right now from what we can see that there's a liquidity problem. Obviously, if the Fed were to move really, really fast, it could kick off a lot more problems in the market. But where we also kind of have to consider is they have a huge balance sheet to work with. So they have, lots of bills. They have the reverse repo facility. There's a lot of money for the Fed to deal with any pockets of illiquidity that come up. But so far, so good. I do think volatility picks up this year. I mean, that's sort of a function of slowly trying to drain liquidity, right? We've had very buoyant markets, particularly in the credit markets, as a result of all this excess liquidity. So, at some point, it's not surprising to see some volatility there. But I don't think that we're near, as Matt said, a breaking point where it's a function problem for the Fed.
5 minutes into this one, let's call it 6. We are higher on the S&P by more than 1%, on the NASDAQ up by about 2%. The Microsoft story helping out there. The guidance is decent. We'll catch up with Ed Ludlow on that in just a moment. Microsoft up by a little more than 5%. After all the volatility, after the big downdraft, the drawdown year to date, many people lining up to say, let's buy the dip. Peter Oppenheimer at Goldman with a nuanced view on this. He said any further significant weakness at the index level should be seen as a buying opportunity. There is a but here. Look out for the growth risk. With more Here's Abby.
Well, John, it's an interesting question for sure, because the sister to buy the dip is sell the rip. So until there's an all-time high, that may be the case. But today, the dip buyers do appear to be out. We have the S&P 500 up more than 1%, as you were mentioning, the best day of the year. And interestingly, over the last 2 days, it felt like the S&P 500 was in a correction because of the brutal volatility. But over the last 2 days, not so much. Right now, the S&P 500 down about 7% from its all-time high. So not in that official correction of down 10%. But the stock selling's not here in the U.S., just in the U.S. It's also on a global basis. The all-world index over the last year higher, but recently at an 8-month low. So a big, brutal sell-off there as investors worldwide wonder what central bank tightening could possibly mean. Of course, also fears around the global growth picture perhaps slowing. As for what is working, John authors here at Bloomberg, he, not surprisingly, shows that it is all about value, buybacks, dividends. On the bottom, though, not surprisingly, folks are selling volatility, growth, momentum, and the highly shorted stocks. Let's see what happens after this Fed meeting. Anything seems possible, John.
Abby, thank you. Let's check in on Microsoft, up more than 5%. Joining us on the West Coast, Ed Dudley. Ed, if you left this when the numbers first came out, you missed the story, didn't you?
Yeah, exactly. The market took a minute to make up its mind on Microsoft, John, because we got the strong top and bottom line beat. But going in to this week of all weeks, really, with the mega caps, Microsoft being the first, we knew that a beat on the top and bottom line wouldn't be enough. They wanted to see the outlook. And if we bring up the kind of key takeaways from Microsoft's earnings, that's exactly what we got. The outlook for the current quarter in terms of Azure sales growth will be rising significantly. And that really adjusted, tipped the scales favorably for Microsoft, because they did have strong growth. Coming into my Bloomberg terminal, this is the 18th quarter in a row where we've seen top line growth above 10%, 20% for the quarter. And even Azure itself grew sales by 46%. 46% growth is nothing to kind of dismiss, John, but it was seen as decelerating, and that was the concern. Let's frame this right. It's Fed Day, John. And I think a hope from the bulls on the street, those following the technology sector, is that we'd have a reset. Microsoft was supposed to be the first mega cap. If we got the strong outlook, then even though it's Fed Day, we'd have a bullish tilt where we stop worrying about the outlook for higher rates and the impact that will have on technology stocks, and just start thinking about the fundamentals. How strong are these businesses, and what is their growth outlook for the rest of the year? But of course, each company has an individual narrative. We go to Apple on Thursday night. We go to Tesla tonight. All of these things have different supply chain, higher input cost headwinds. And this is what we want to see, that outlook for the year. We may get top line growth in the quarter just gone. There's some seasonality when it comes to Apple. Will that be good enough?
Ed Ludlow on the three big names to report this week. Ed, thank you. Ed mentioned those three names. So yesterday we had Microsoft, today Tesla. Tomorrow, we'll hear from Apple. Those three names, more than about a quarter of the NASDAQ 100. Microsoft makes up a little more than 10%. So think about that move in Microsoft as you look at the NASDAQ 100 this morning. Microsoft up by almost 5 percentage points, and the NASDAQ doing nicely too off the back of it. A final word now from Matt Hornbach, Robert Tipp and Kathy Jones. All three of you are across credit to some degree, some greater than others. And Robert Tipp, I want to start with you. I want to gauge where you think things are, just in terms of corporate fundamentals, where leverage is, what the maturity profile looks like more broadly as we start to enter what looks like a big rate hiking cycle. What do we look like, Rob?
Yeah, I would say the corporate sector is in good shape. I mean, the upgrade to downgrade ratios are very strong, and they've had a very high issuance, buoyant market to reprofile maturities. There are virtually no defaults last year in high yield. So it's been a very strong credit environment, and I don't think the central banks are going to take enough of an edge off the economy here to really dampen them. And those underlying fundamentals are there for structured product as well, by and large. So very strong underlying fundamentals. Now, spreads have gotten incredibly tight, but I think what we're looking at is a range-bound market for spreads. It's going to be a bond pickers market. But on average, as we go through this, I think your long rates probably remain range-bound on the Treasury market. Your spreads remain relatively range-bound, and there's a lot of bottom-up opportunity. So I think a reasonably good environment for credit, and that usually, is the case on the credit side at this point in the cycle, and it's also often the case in these recent cycles. The long rates also peak early in the Fed cycle.
Matt Hornbach.
John, yeah, we share the same view. I think, honestly, what we're more focused on is what's happening in the agency mortgage market in the U.S. The type of spread widening we've seen in agency mortgages, which, of course, is a security that the Fed holds a lot of these days. That, to us, is really the main focal point, especially when we think about credit and how investors might be allocating to credit vis-a-vis agency mortgages. Of course, looking at core plus portfolios, that's a big decision for managers to make. So the widening in agency mortgages is something we are going to be tracking very closely. And by the way, John, if you look at how agency mortgages have been performing alongside real interest rates in the U.S., the correlations have gone to 1, essentially. So we think that this is really the main focal point, given that we're facing the Fed decision today.
Kathy Jones, final word.
Yeah, I think the corporate fundamentals are very good for credit. We've seen a little bit of spread widening, but not very much. They're really hanging in there pretty well. I think if there's one thing that concerns us is that in every tightening cycle, you find out where the weak spots are. And in high yield, one of the risks to us is simply that investors pull out, look at more attractive opportunities with less risk. And so we're worried about the level of tightness in spreads in the high yield market vis-a-vis the tightening cycle. So that's where we'd be a little bit more cautious. But in general, credit looks pretty strong.
Kathy Jones, Robert Tipp, Matt Hornbach on this Fed decision day. A busy one for us all. Thank you so much for giving us so much of your time. About 13 minutes into the session, the S&P 500 up a little more than 1%, on the Nasdaq up by 1.73. Coming up on the geopolitics, the president ruling out American forces in Ukraine.
There is no intention or interest or desire by the president to send troops to Ukraine. NATO is a forum to support our eastern flank partners and countries, and that's what the focus has been on.
That's next. This is Bloomberg.
We have no intention of putting American forces or NATO forces in Ukraine. But as I said, there are going to be serious economic consequences if he moves.
President Biden considering sanctions on the Russian President Vladimir Putin should Russia invade Ukraine. The UK mulling tougher actions of its own, with Foreign Secretary Liz Truss telling Sky News the following: "We are not ruling anything out. We will be bringing forward new legislation to make our sanctions regime tougher so we are able to target more companies and individuals in Russia." In Washington, Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John. Well, when we look at the sanctions picture across the transatlantic, this is really the heart of some of the tensions we are seeing, and especially when we look at what's going on in Germany. According to Bloomberg documents, Germany is trying to have this carve out if there was going to be a block on transactions of U.S. dollars for the Russian energy sector. And of course, we talked about this. This is because Germany is so reliant on Russia's cheap oil and gas and on energy imports in general. And Olaf Scholz really spoke to that this week. He said that these sanctions need to be prudent. No one should be under any illusion that these sanctions are also not going to hurt us. This is at the heart of the problem. How does the West inflict pain on the Kremlin at the same time not damaging their own economies? And then, Jonathan, a little bit of a bizarre move. We talked about it earlier. It's not just Germany. When you have Italian executives ignoring the calls from the Prime Minister, Mario Draghi, to not get on a conference call with President Putin to discuss investments in Russia, you can see the intertwined relationships between Europe and Russia when it comes to the business community.
Isn't this part of the goal, to expose some of the divisions in Europe? Isn't that music to the ears of Russian leadership, Anne-Marie?
It certainly is. This is what they want. This is what President Putin loves seeing. He wants to see a divided West. This is why he likely clapped when there was Brexit, and obviously a withdrawal from Afghanistan, a divisive America, things like January 6th. These are, as you say, music to his ears. And now, as they are talking tough and say that they are in lockstep and in harmony when it comes to sanctions, what's actually playing out is the fact that he sees that it is not going to be as easy for Europe to come down and incredibly harsh on the Kremlin when it comes to sanctions, because there are a number of countries who don't want to inflict the damage on their own economies.
Yep.
And this is really the question the West has to take into consideration. And we should note, Jonathan, that since the sanctions following the annexation of Crimea, the Russian business community, and I've spoken to a lot of these executives from St. Petersburg to Vladivostok, they have really started to insulate their economy to try to make it sanctions-proof.
AMH down in D.C. Anne-Marie, thank you. Crude right now just short of 90. 89.67 on Brent, up more than 1% on the day. On WTI, just short of 87 at 86.89, up 1.5%. Goldman's Jeff Currie had this to say. He expects geopolitical tensions to have little impact. Take a listen.
Our base case is no disruption. It's very unlikely. If we think about the sanction-imposed disruption, I like to call it mutually assured destruction. It's not in the interest of any party to stop flows of energy through Ukraine or even into Western Europe.
Let's get to Bloomberg's Julian Lee. Julian, do you agree with everything Jeff Currie just had to say?
Yeah, I do. I mean, if you look at the geography, there's not likely to be any physical impact on flows from any incursion of Russian troops into Ukraine, should that happen. The pipelines that carry oil and gas into Europe, those that cross Ukraine, cross northwestern Ukraine. Any fighting is likely to be in the southeast, so there shouldn't be any sort of physical collateral damage. And as both Jeff Currie and Anne-Marie said, for Europe, the imposition of sanctions that limit Russian exports of oil and gas to European consumers is going to come at a very high cost.
That lead paragraph from Alberto Nardelli in Bloomberg, that the German government has pushed for an exemption for the energy sector if there is a move to block Russian banks from clearing US dollar transactions. That's according to documents seen by Bloomberg. That got our attention, Julian, but it didn't surprise you, didn't surprise Anne-Marie, didn't surprise me, and I imagine it didn't surprise many people who have just heard it. Julian, what is surprising to me is how little we've seen an effort, a big effort, to actually build up some real energy infrastructure where we can pare back the dependence on Russian gas in Europe. Why haven't we seen a bigger effort in Germany, not just over the last few years, Julian, but you've been following this for decades. Why haven't we seen that?
Well, I think, actually things in Germany have been moving in the opposite direction. We've seen, if you like, a growing dependence on Russia. And that's largely because up until very recently, Russia has been a reliable supplier of energy to Eastern Europe and increasingly to large parts of Western Europe. We're seeing domestic production within Europe going down. North Sea oil production is going down. Dutch gas production has gone down very sharply. The biggest and North African supply has been going down as well. And that was one of our other big import sources. The area that's been growing, that has been easily accessible to Europe, has been Russia. So we've seen new pipelines being built to carry gas directly into Germany. We've seen new export terminals for Russian oil being built on the Baltic coast, supplying more crude oil and refined products into Europe. And other projects just haven't had the same, either the same heft in terms of volumes. When you look at natural gas pipelines from the Caspian Sea, they exist, but that shifts a reliance on Russia to a reliance on Turkey, and that doesn't really suit many people in Europe.
Julian Lee, on a situation that is not changing. If you think it's a problem, and we're told repeatedly it is, it's surprising to see very little done about it. Up next, your trading diaries. We count you down to a Fed decision just hours away. From New York City, this is Bloomberg. "26 minutes in, you've got a lift here. Does it stick?" We've seen a lot of these moves go into reverse in the second half of the session. That's going to be dictated by Chairman Powell, you'd imagine. Up 1.8% on the S&P, a little more than 2% on the Nasdaq. The bond market story going into the Fed looks like this. Yields on a 10-year right now at 179, just a bit higher, up 2 basis points. Up 2 on twos as well, through 1% to 1.03. 7.2. That's the price action. Here's your trading diary. New home sales at the top of the hour. President Biden meeting with private sector CEOs at 1 p.m. Eastern. We got a Fed rate decision and Chairman Powell news conference at 2 p.m. US GDP and Apple earnings coming up tomorrow. And finally, the employment cost index rounding out the week on a Friday. From New York, I'll see you later for the Fed decision. This was the countdown to the open. This is Bloomberg.